So this is chapter 16, part 2 of the lecture video. And we're just following up back to our example of the job costing. We have, at this point, just requisitioned some direct materials into the 3 jobs that we're working on. We requisitioned a total of $19,500 of direct materials and a total of $2,500 of indirect materials. Now the entry to record this, again we're using our general ledger accounts, would be to debit work in process, and that's for our direct materials, and that would be for the $19,500. We're also going to debit factory overhead. That's for our indirect materials for the $2,500. We're going to credit materials, the materials account, and that's for the total materials that were requisitioned. So not only the $19,500, but also the $25,000, and so that's the full $22,000 that came out of the storeroom. Now remember, the $2,500, that's the actual amount that goes into factory overhead as a debit. We're going to apply factory overhead based upon the predetermined rate of 75%. So the $2,500 does not go into the jobs. We're going to do that as a separate step by applying the factory overhead rate to the jobs. Okay? The second step would be to basically assign the direct labor. So direct labor costs, and again these would be given, for job 1 would be $6,000. Job 2 is $4,000. And job 3 is $8,000. And we're also going to have indirect labor such as supervision costs of $3,500 for this period. And that would go, again, since it's not a direct cost, it's an indirect cost, it's actual, goes into factory overhead as a debit for $3,500. So the entry we would make here, so let's first of all add up direct labor. That would go into our work in process account. So it's the $6,000 in job 1, the $4,000 in job 2, and the $8,000 in job 3. So that's a total of $18,000 that would go into our work in process account. And it's in our individual jobs. So the entry we would make there, and I'm just going to scroll down a little bit, would be to debit work in process. And again, that's for direct labor. And that's for $18,000. Factory overhead. And that's for the indirect labor, $3,500. And our credit, in this case, we're going to say it's wages payable. For $21,500. Okay, so let's say that we had some additional factory overhead. Let's say we had depreciation of $2,800 and utilities expense of $4,600. So again, we don't use expenses anymore. Instead, all indirect costs at the factory would go into our factory overhead account. So depreciation, and again, these are just I'm just writing depreciation here only just as a descriptor. It's really going in as a debit into our factory overhead account. 2,800 and utilities 4,600. Again, these are actual amounts. So what we're going to do in terms of entries would be, instead of debiting depreciation expense, credit accumulated depreciation, we're going to debit factory overhead for 2,800. Credit accumulated depreciation 2,800. So again, no expenses at the factory. It's either going to be direct materials, direct labor, or factory overhead. In this case, it's an indirect cost. It's going to go into factory overhead. Same thing with utilities expense. It's not going to be an expense. It's going to be factory overhead and probably just accounts payable for the utilities expense. 4,600 debit, credit accounts payable 4,600. So again, actual amounts go into factory overhead, and we're going to apply factory overhead to the jobs based upon the predetermined rate. Okay, so let me scroll down a little bit. All right, so now we are going to go ahead and apply factory overhead to the jobs. And we're going to do that based upon 75% of the direct labor dollars in each job. So for job 1, factory overhead, 75% of 6,000 would be 4,500. Remember, we're using 75% of direct labor dollars to apply factory overhead. Factory overhead for job 2, because remember, this is at the end of the period, and now we know how much our direct labor costs are. 75% of 4,000 would be 3,000. And 75% of 8,000 would be 6,000. And so if we add up all those factory overhead amounts, that would be a total that goes into work in process of 13,500. And that's how much comes out of factory overhead. That's what's applied out of factory overhead and into the jobs for the month, 13,500. And so the entry here would be to debit. Again, we're talking just about general ledger accounts. Debit work in process for 13,500 and credit factory overhead right here for 13,500. So that's how we've allocated all of our costs for the month into each job. Direct material, direct labor is directly allocated, and we would know those amounts. They would be directly traceable. And then factory overhead based upon our predetermined rate. In this case, a rate that's based on direct labor dollars. Once we know the dollars for the month, we can go ahead and make the factory overhead allocations, and now we're done. The next step would be to account for the fact that jobs 2 and 3 are completed and job 1 is not. So what we're going to do is we're going to add up the total costs that have been incurred up to this point. Job 1, $15,000. Job 2, $13,000. And job 3, $23,000. And if we looked at it up above, the total, of course, would be the sum of those three, which would be $51,000. Now remember, jobs 2 and 3 are completed. So the completed jobs are the ones that are transferred out. The not completed jobs, job 1, is the job that still stays in work in process. So the completed jobs would be transferred out here into finished goods. So basically job 2, the 13,000, would be transferred out, and job 3, the 23,000, would be transferred out. So a total of 36,000 would be transferred to finished goods. Those are the two jobs that are completed, and that 51,000 minus 36,000 up above would leave us 15,000 of ending inventory, and that's exactly what job 1 is, 15,000. That stays in work in process until it's completed, perhaps the next period. So the entry to record that would be debit finished goods inventory, 36,000, credit work in process, 36,000. And again, that's really the key entry, because that really tells us that that's the cost of our completed jobs. That's the cost of the jobs 2 and 3. Job 2 cost us 13,000. Job 3 cost us 23,000 to manufacture. And now that's the cost of those jobs that are in ending inventory. And that's the cost that would eventually make its way into cost of goods sold when we sell that product. So let's say, for instance, we were to sell, let's say we sell 100 units of job 3. And let's say job 3 we made a total of 1,000 units. So if we made 1,000 units of job 3 and our total cost was 23,000, that means that each unit costs $23. So that's our cost per unit. So we'd have a debit, let's say debit accounts receivable, credit sales for whatever we sell them for. Then we would have, if we sold 100 of these, we'd have debit cost of goods sold for 100 times 23, 2,300, and credit, 2,300, and credit finished goods, 2,300. So that would be the entry if we sold 100 units. Finally, if this was the end of the year, what we could do is we could total up our factory overhead. This side would be 13,400. Of course, our credit is 13,500, so we have a net credit balance of $100. So we'd simply debit factory overhead for 100 and credit cost of goods sold for 100, and that would close out our factory overhead account to 0, where we'd start the next year. So those are all the entries that you would need to make. It's all, again, laid out using T accounts. I think that's probably the easiest way to see what's going on in this particular problem. I think the T accounts are probably the simplest way to understand how the costs are flowing, and especially when using the subsidiary work in process accounts.